Hey everybody, hopefully you all understand the concept of debits and credits, because in this tutorial we're going to be covering specific accounts that fall within assets, liabilities, and equity, and we're going to be talking about their normal balances. And you haven't missed anything. We have not talked about normal balances yet, but by the end of this presentation you will understand what normal balances are. I guarantee that. And we'll also touch on 3 more confusing or frustrating accounts and their normal balances, and a little explanation about what they are, what they do, etc. So right away, accounting equation: assets equals liabilities plus equity. Got to know that like the back of your hand for all quizzes and tests. And the left side, which are assets, are all increased using debits. Right side accounts, which are liability accounts and equity accounts, are increased using credits. And I have some asset, liability, and equity accounts right here. The left side are all asset accounts, middle are all liability accounts, right side are all equity accounts. And you're going to see this term normal balance come up frequently. I actually put it under every single account. What does the term normal balance mean? Well, for each of these accounts we can either debit or credit them. What normal balance means is that in order to increase the balance of an account, we will either have to debit or credit it. And whether we increase an account using a debit or a credit is going to be known as the normal balance. So in the case of assets, since we increase that account using a debit, the normal balance for all asset accounts will be a debit. The normal balance for all liability and equity accounts will be a credit, because we use credits to increase those accounts. Very simple, right? And I just created all these different accounts for reference in case you ever are wondering whether to debit or credit a certain account. Okay, let's move on to the next parts, which are some of the more confusing and frustrating accounts, and they're actually known as the red accounts, which are revenues, expenses, and dividends. But let's just talk about revenues at the moment. So revenues, if you actually think about them, do they fall under assets, liabilities, or equity? Well, they really don't follow, or they don't fall underneath any 3 of those elements, but they are indirectly associated with equity accounts. You can actually say they kind of are an equity account, because revenues, what revenues do is they indirectly affect retained earnings, and when retained earnings are affected, equity is affected. So let's actually write this down and follow how this works. Okay, revenues, I think most people understand that revenues increase the level of income for a certain company. When we increase the income of a certain company, we're going to have more retained earnings, because more income in each fiscal period will lead to more earnings that are retained within the firm. When we have more retained earnings, it will increase equity. And when equity is increased, we credit equity, which is why revenues have a normal balance of a credit. So if we want to increase revenues, we have, let's say we report some revenues that are earned, we will credit revenues, because to increase the revenues account we use a credit, or what did I say, to increase a revenues account we will credit that entry. And let's move on to the next one, which is the expenses. And expenses, let's see how they affect equity. So expenses are actually detrimental to your firm. Well, not really detrimental. You actually need expenses to earn revenues. You just hope that your expenses aren't more than your revenues, or else you're going to be having losses. So expenses lead to less income. Less income leads to less retained earnings. And when retained earnings goes down, we are going to have a drop in equity. And when equity is decreased, we are going to debit So that makes sense why expenses have a normal balance of debit, because expenses decrease equity accounts. Revenues increase equity accounts, which are why they are credited. Expenses decrease equity accounts, which are why they are debited. And finally, we have dividends. And dividends are a little bit more complicated because people aren't really familiar. Maybe if you just got into accounting, you don't really understand equity markets yet, and it can be a little bit confusing. So dividends are actually a share of the earnings that are dispersed to shareholders. So let me actually write that down. Dividends are income to shareholders. And they are actually not an expense. They are actually an after-tax disbursement from a net income. So it actually has no effect on income, but it will have an effect on retained earnings. So when we issue dividends, dividends will lower retained earnings because some of that earning or income, retained earnings, is essentially retained income. Some of that income is going out of the company, so it makes sense that dividends lower retained earnings. And when retained earnings are lowered, equity is going to go down. When equity goes down, we debit in order to decrease equity, which makes sense why the normal balance of a dividend account is a debit. So always think about what is going on with the main element. If equity is being decreased, we are going to have a debit as the normal balance of that account. If we are increasing equity, the normal balance will be a credit. So hopefully you understand kind of how revenues, expenses, and dividends work, and that is mainly it for this tutorial. So I'll see you guys in the next one. I think we'll be talking about posting to the general ledger in the next tutorial. See you guys then. I'm sure you guys have questions regarding accounting topics or our videos, so make sure to tweet us at #iNinjaNotes, like us on Facebook to receive updates, or to share any quick anecdotes about how our videos might have helped. And like always, thanks for watching us on YouTube.